Well, good evening, everybody. My name is Jennifer Olmstead, and I would like to welcome everybody to our webinar this evening. In partnership with Bank of America Private Bank, this is part 2 of our 2-part webinar series on financial wellness for physicians. Our 2 speakers tonight are going to be Dirk Harris, who is the Senior Vice President and Client Advisor with Bank of America Private Bank, along with Eric Baggett, Senior Vice President and Wealth Strategies Advisor, also with Bank of America Private Bank. Now, before I hand things over to them, I wanted to just let everybody know that if you have questions throughout the presentation, please feel free to type them into the chat box, and we'll try to get to them as we move through the presentation. We've also saved time at the end of the program for additional Q&A, so feel free to type all those questions in the chat box. And if anybody would like to receive a copy of the slides from tonight, feel free to send an email to sdcms@sdcms.org, and we'll get a copy of those slides sent to you. And now, let me introduce Dirk Harris, who's going to start the presentation this evening. Dirk?
Thank you, Jen, and welcome everyone. Nice to see you virtually, at least. And thanks for joining us tonight. As Jen alluded, we will be covering a few topics in the second part of our series. These 3 topics: starting a business, saving for retirement, and giving back, will build on the where we started the part 1. Eric will kick us off with talking about business and starting a business, and then we'll continue into savings for retirement, and then round it out with giving back. So with that, Eric, the floor is yours.
All righty, thanks, Dirk. Thanks for the introduction. Yes, good to be with you all tonight. The first topic will be starting a business. I helped clients while I was primarily a tax and estate planning attorney. I did help clients with kind of their business startup plans, filing the legal documents, and kind of walking them through all the steps they need to take to get a business up and running. So I'll walk you through the slides here. Dirk, are you going to share? Is it already being shared? Or there we go, perfect. If you want to go, let's see, to slide 4 as we'll start. One more, sorry. Yeah, perfect. Okay, so this is just kind of an outline of what this section of tonight's discussion will cover, starting a business from kind of step 1 through step 6 is how we've divided it up. So first and foremost, you can see it, creating a business plan, making sure, analyzing your finances, make sure you're going to be on solid enough financial footing to survive the startup phase, assembling your team, not so much, we said create an advisory team here, not so much a board of directors or board of advisors, but really just the right professional advice, attorneys, accountants, those types of advisors to advise you on setup and operations, especially during that first year. Determining the type of legal entity, and I'll go through the various options that are available. Most in your cases being physicians. I would assume that the business you would be considering to start, if you are considering to start, would be a medical practice. And so the considerations in terms of entity selection when it comes to a medical practice are more limited than a general business, but I'll focus in on what the options still are. Insurance to guard against the risks, and planning for taxes that will ultimately do once the venture is successful. So first and foremost, I think the starting point is the blueprint of putting together a business plan. I mean, this is really for your own benefit. If you're considering starting a business, it's unlikely that you'll really ever submit this to anyone, especially if it's a medical practice. You're not likely to have investors or venture capitalists or outside individuals interested in your plan. It's really this is valuable in terms of making you go through the mental exercises first to describe what your product or service will be. That's probably fairly obvious in your cases as physicians, as you likely already have a specialty. What your target market is in terms of who you're likely to serve may impact where you want to be located, where you want to work out of. outlining the financial aspects of your business in terms of where's the startup cash coming from? Is it something that you've saved for individually, or is it something that you're going to perhaps need to tap into a line of credit or some other source of capital that would require a banking relationship of some sort? Next, I would say show the type of business entity in your business plan, which entity makes sense based on what you're trying to accomplish. Have control, limit liability, be tax efficient are the big three in terms of the considerations. Next, your business plan should talk about the outside licensing, registrations. All businesses require them. Even if you don't form an entity, you're going to have licensing, you're going to have registrations, in your case with the California Medical Board, I believe. You're going to have safety requirements you have to comply with, tax requirements, plethora of different filings with different agencies that you should be aware of, have done your research, know which ones are going to apply, and make sure that those are properly registered from the outset. And then finally, a business plan will identify the risks in terms of what risks are out there, what risks can be avoided through proper entity selection and proper business protocols, and then what risks are simply part of doing business that will have to be guarded against through insurance or other set-asides. So that's kind of the summary of that. But again, that's really more for your benefit to make sure that you've done the mental exercise of going through and looking at what all the risks are, and that you adequately planned for them. So next, I would say it's the financial analysis, both the finances of the business that you're going to go through, as well as the personal finances. So if you're going to, if this is a business, if this is a medical practice that you're going to start, how much of this can you do upfront in advance of starting the business, where perhaps you are still an employee of another medical practice, an employee of another large healthcare institution where you can continue to get paid. In most cases, there's some amount that can be done up front, but there often comes a time where the cord has to be cut in order for you either to pursue it full time, because you need the time to actually get the business up and running, or because your current employer might have an issue with you after they find out that you've been spending a lot of time setting up, laying the groundwork for a new business, and so you may have to cut that cord earlier, just in the event of limiting potential bad blood at the minimum with your current employer, or potential legal ramifications of using their time or resources on a competing business venture that you plan to start up. So that's something to take into consideration as you consider the finances of the business. And then also making sure personally, how long can your family go without a steady source of income? Even if you are able to get the business startup on good footing while still earning compensation from the prior employer, there will be a time in terms of how long it takes until you're completely up and running, seeing patients or whatever it may be, earning revenue, and then collecting that revenue. And that's certainly likely to be a number of months. A good rule of thumb is 6 months that you have, that you could go without any income for 6 months, and that you could both fund the business if you needed to, again, either through personal sources or some sort of line of credit with a bank or other sources, and that you could continue to fund your personal life, your family life, and meet all your personal obligations while you're in that pre-revenue stage of the startup. Next would be our creating an advisory team. This is generally who we think of as the initial advisors that are likely going to be involved with your business startup. You're going to have the attorney who you consult with on the business formation, in terms of if you're likely to choose that you need to do business as a formal entity, which entity makes sense in terms of entity selection. And then the attorney will help you kind of go through the pros and cons of that. And then ultimately, once you've selected the type of entity, prepares the necessary legal documents that both govern the entity internally and have to get filed with the state, in terms of if you choose to go the corporate route, filing articles of incorporation, preparing bylaws, selecting officers and directors, things of that sort. That's what your attorney will walk you through. Next, you would have your accountant. You want to make sure, first and foremost, your accountant might be able to run projections in terms of likely startup expenses, likely revenue. They might serve as more of a bookkeeping function for you initially to track revenue, make sure it's properly accounted for, give you an idea of what your runway truly needs to be before you're to get from the pre-revenue stage of the business to the revenue stage. And then ultimately helping you file tax returns after you've presumably had a successful first year, and every year thereafter, helping make sure that you're making your estimated tax payments and ultimately filing your tax returns on a timely basis. Third would be your banker. A banker might help you with the startup capital, obviously to start the business, might help you with a line of credit that also allows the business to survive the first year when revenue will be less than anticipated in future years. And also it might just be there as you, even when you're in the revenue stage, sometimes revenues come in on an irregular basis and you need a line of credit to kind of bridge certain time periods where perhaps there's a delay in collections or just a gap between collection periods. So you'll likely have a relationship with the banker on an ongoing basis, even if you don't need startup capital from the outset. And then fourth, the insurance advisor, guarding against the risks out there in terms of, first and foremost, malpractice, liability coverage, property and casualty coverage as it relates to the contents located inside the physical business. And then also putting just standard plans in place for, health insurance. Once you're no longer on an employer's plan, you have to have your own health insurance. If you have employees, you're likely or anticipating to have employees, you're likely want to have a plan that provides insurance to employees. There might be a life insurance component as that plan. There might be a disability component. But anyways, having all the typical insurance, the insurance products that a typical business would have. You might layer those on, start with just the liability and the casualty and the health, and then layer on employee plans as you grow. All right, so then this is, I'd say this is the part when I was in private practice I was most instrumentally involved with, because this is the entity selection. So this is the task that your attorney will primarily be in charge of. So really when it comes down to what types of businesses, what types of entity you can choose to do business as, you have the most basic, the sole proprietorship. This is basically, if you choose to do business and not formally set up an entity, then by default, if you are operating on your own, you will be deemed to be a sole proprietorship. So it's simple. There's no required filings. You might file a DBA, a registration that shows the name of your business and what you're doing business at, but there's no legal filings with the Secretary of State, no articles of incorporation, no bylaws, nothing of that sort. So it's simple. The trade-off being it is a unlimited liability business structure, in that you will be liable for all the potential liabilities of the business, both personally liable, business will be liable, and you will be personally liable. So all liability that the business might incur or you might incur while working at the business flows through to you individually. So that's often not ideal. And typically I only see sole proprietorships where people haven't put together a business plan, because if they did and went to an attorney, they most likely would have been advised that it's not a good idea to do business as a sole proprietorship, even though it might be simpler. Secondly, I'll skip over here, a partnership. A partnership is basically, a general partnership is basically the same thing as a sole proprietorship. It's just when there's more than one person involved. So again, simple to set up. By default, when two or more people engage in a business venture for profit, they are then by default a general partnership. And just like the sole proprietorship, they have unlimited liability for partnership debts and expenses, and that liability flows through to each partner individually. So for the same reason, generally not advisable to do business where there is the potential exposure to liability as a general partnership. You could set up a business generally as a limited partnership or a limited liability company. These do have the effect of limiting liability in the case of a limited partnership All limited partners are not liable for partnership debts and obligations, and same with a limited liability company. All the members are not personally liable for the debts and liabilities of the entity. That being said, I think it's the medical board, California Medical Board, actually prohibits physicians from engaging in a medical practice as either a limited partnership or a limited liability company. So for the most part, that takes those entities off the table. However, I have still seen them involved in medical practices, but it's usually for the ancillary business activities. For example, I've seen where the medical practice, the owner of the medical practice owns the practice, but also owns the business that the practice operates. Or sorry, owns the real property that the business operates out of. And in that case, the holding company for the property from which the business operates is often formed as a separate entity, in which case that can be a limited liability company. Also, I've seen ancillary services that physicians sometimes provide. Like I had a physician, a dermatologist who also had a line of skincare products that she had developed, and that business was separate and apart from the medical practice in its own entity, in which case a limited liability company or a limited partnership would be available for that type of business. But as to the practice itself, really the options are going to be sole proprietorship, general partnership, or a corporation. And because of the and a corporation is the most formal, it requires the most steps to set up. You have to file as articles of incorporation with the Secretary of State. You have to prepare bylaws. You have to select officers and directors. You have to have annual meetings. You have to make annual filings with the state. You have to pay an annual filing fee to the state. There are numerous filing requirements. That is what I see most medical practices set up as, a corporation, and specifically a subset of corporations called a professional corporation that medical practices are required to form as under California law. And so if you choose to set up a medical practice as a corporation, it will have to be a professional corporation. And what really that means is that you also have to register the corporation with the California Medical Board in addition to all the Secretary of State filings. And I believe it's a majority of the shareholders in the corporation must be licensed physicians in the state in order for it to be qualify as a professional corporation. So that's the legal entity that we refer to it as. The tax filing, though, is it can either be a C corporation or a S corporation. Let's see, I think I've gotten a little ahead of myself. So you can switch to page slide 10, if you will, Dirk. This kind of goes into a little bit more. So all corporations, if you're a medical practice, are going to have to be a professional corporation as defined by the state of California. But then for tax filing purposes, as defined by the IRS or the Internal Revenue Code, you will have to select whether or not you want that professional corporation to be taxed like a C corporation or an S corporation. And without getting into too much detail, really what it means is an S corporation is taxed just like a partnership or a sole proprietorship or an LLC, in that it's a pass-through entity. So income and deductions generated by the S corporation pass through to the shareholders, and then the income tax due by the S corporation is paid on a pro rata basis by the shareholders. So it's what we call a pass-through entity. Income deductions pass through to the shareholders. Shareholders pick it up on their individual return. So if you had your own medical practice, you were the sole shareholder, 100% of the income and deductions would flow through the S corporation and get picked up on your individual return, and you would pay the typical individual income tax rates on the income generated by the S corporation. A C corporation is what we think of kind of your big national, international, multinational corporations. They're almost all your publicly traded companies. They're almost always formed as C corporations. A C corporation has more filing requirements, but it also has a dual tax system in that the C corporation will not be a pass-through entity. It will be a taxable entity in and of itself. And so the income generated by the business will be subject to a corporate level tax at the corporate tax rates. And then after that tax has been paid, if income is then distributed out to the shareholders, typically in the form of a dividend, then you're going to have a second level of tax at the shareholder level. And so typically that dual tax, the double taxation of the corporation's income has prohibited most small businesses from registering with the IRS as C corporations. They would have rather had the S corporation status, not have two layers of tax, just simply pick up all the income tax on the shareholder's individual tax return. However, recently there's been kind of two developments that have brought C corporations, even for small businesses, even for a medical practice, back into the discussion. One of those being the C corporation rates were dramatically reduced from 35% to 21% by the 2017 Tax Act. So now the C corporation rate is 21%. So you have that tax, and if a dividend was distributed out, you might have a dividend taxable to the shareholder at somewhere between 15–20%, in which case you're right around 40% total tax rate. The S corporation flows through to the individual at the individual rate, and the top rate is 37% for individuals. So basically now the double tax, the cumulative effect of the double tax in the C corporation context is similar to the total tax in the S corporation context, where it's taxed at the individual rate. And so because those are closer, clients are now looking at potentially forming as a C corporation, because if they can operate for basically the same tax liability as a C corporation as they can an S corporation, there's one benefit available to C corporations that isn't available to S corporations, and that's meeting the definition of being categorized as qualified small business stock. A C corporation, a qualified small business corp, has to be a C corporation, but if you qualify the C corporation stock as qualified small business stock, and you hold it for 5 years, so you operate the business for 5 years, and then you sell the business, qualified small business stock gets a $10 million gain elimination upon sale. And so you could essentially sell a small business that, as long as it qualifies as qualified small business stock, and not incur any tax on the first $10 million of gain upon sale of that business. That's a huge, it's one of the most powerful tax benefits in the tax code, and that's only available to C corporations. So that came into effect at the 100% gain elimination level in 2018. So we had these two things that changed the environment in 2017 and 2018, where now if ultimately your exit from your business might be the sale of a practice, and this would apply even if your business is already up and running, if your exit might be a sale to a third party at some point, if you can do business for the same tax bill year after year as a C corporation as you could an S corporation, or at least close to the same tax bill, and that it's not that much more expensive, well then why not consider doing business as a C corporation? Because when you sell a C corporation, if it's qualified small business stock, if it meets all the requirements, you can eliminate the first $10 million of gain, saving you millions of dollars in capital gains tax. So that's brought that back into at least the discussion. Most small businesses, most medical practice have not gone that direction as of yet. Most are still pass-through entities, but like I said, it's at least part of the discussion right now. Let's see, yeah, moving on to the next slide here. So this really talks more about kind of the partnership, general partner, limited partners. I won't go into much detail because, like I said, general partner, forming a general partner is what occurs by default when more than one person is engaged in the business. And it's not ideal because there's no liability protection individually from the debts and obligations and liabilities of the partnership. In that case, all partners have complete control, but they also have complete liability. So that's less than ideal. And like I said before, limited partnership is not available in the context of a medical practice. Same with a limited liability company, not available. You might consider, very well likely, if you do have an ancillary business practice, either owning the real estate from which the business operates or selling some other product or service that is ancillary to the practice itself that can be spun off as a separate entity, then you're likely probably going to be in the LLC context for that business, but not allowed for the medical practice itself. So then once you're up and running, you pick your entity. Now you're looking at your insurance needs, making sure you have this in advance. So I went over these a little bit earlier, but making sure you have health insurance since you no longer under an employer sponsored plan, making sure you have disability insurance if you're the primary income earner in your household. Might want to consider expanding existing policies. A umbrella, generally a general business owner's property that covers the tangible personal property equipment that'll be located in the business, and then an umbrella policy to cover anywhere that the other policies perhaps bump up against the cap or don't cover. Generally a good idea. And then of course, professional liability, medical malpractice insurance, critical in your line of work. And then if you have other employees, you'll need workers' compensation insurance. If you're using vehicles that are company vehicles, you'll have to be changing the policies likely on those vehicles from a personal use to cover the business use of the vehicle as well. So this is just a handy grid in terms of kind of the different attributes of the different businesses. Breaking down, you can see by type. I won't go through each quadrant here, but in terms of the limits and on the numbers that can be involved in each case, and then which ones are easy to form, which ones have limited liability, which ones have a more flexible management structure versus control dictated by the entity style, and then the taxation of income in terms of whether it be a pass-through entity or a C corporation that has the double tax. So, but that's a good, quick, ready reference for you. And then finally, as it relates to having the right type of accountant in place, an accountant that initially at the outset can probably help you with more of a bookkeeping function, projections in terms of what your runway needs to be to finance operations while you're in the pre-revenue stage, projections on what your revenue will likely be, help set you up with making the proper estimated tax withholdings, especially during first year, to make sure that you don't under withheld and be subject to penalties, and then also potentially over and set aside more money than taxes that is necessary when that money could be helping finance operations during the first year. And then ultimately filing the tax return and making sure you're doing that on a timely basis. So that's my section. I think we have a couple questions here, so I'll go ahead and field those right now before we change topics. So if you're a doctor that works alone and is a consultant, do you recommend being an LLC or an S corporation? What is the advantage and disadvantage of both? And so even if you're a solo and you're engaged in the practice of medicine, I bet the Medical Board Society, even as the California Medical Board says if you're going to form an entity, you're likely going to have to form a professional corporation. And so in that case, the corporate route, if you're going to form an entity, an LLC would not be available, in which case your option is limited to professional corporation. So the decision you would likely have to make is whether to file with an S corporation status with the IRS and pay one level of tax, or pursue the C corporation election and then pay 2 levels of tax. So, and then the second one says, sounds like you can't be a C corporation if you have a small business. Is that correct? No, you can be a C corporation. It's just been prohibitively difficult. And most people, it was more expensive. When the corporate tax rate was 35%, then the 35% corporate level tax, and then the dividend out to the shareholder would have been in excess of 50%. And so you didn't see a lot of small businesses being C corporation because it was a lot more expensive from a tax perspective to be a C corporation. That's no longer necessarily true. Now you have to crunch the numbers. And if that's the case, you can be a C corporation. You may elect to be a C corporation if you at some point envision selling the practice and want that tax-free exit from the sale, then you very well will be that. Any business too, and that would apply with an ancillary practice. If it's something you ultimately intend to sell and could benefit from that qualified small business stock provision that would eliminate the first $10 million of gain on sale, then you would consider being a C corporation for any type of business. So hope that answered it. Oh, and I have a follow-up here. I should clarify, solo doctor working as a locums. I don't know what that, I'm sorry, that's a medical term I don't know, I think. LOCUMS. Should I be an independent contractor, LLC, or S corporation? So an independent contractor can actually apply even if you are an LLC, an S corporation, or a C corporation. So if you are available, if you're not going to be governed by the California Medical Board, then you could pick either an LLC or an S corporation, and both would be a pass-through entity, and both technically you would, if you were the only person there, would still be classified as an independent contractor in terms of how you get paid. You would be issued, you know, a 1099 for services rendered as opposed to W-2 income like compensation of an employee. So so you really could do either, and the LLC and the S corporation will largely come out the same from a tax perspective, and from a limiting liability and protecting you from the liability of the business perspective. Either one would work. The C corporation is going to be strictly dictated on does it pencil out from a tax perspective and on your tax-free, and do you ultimately desire, could your business be sold without you? If it's not, if it's just you, then it likely doesn't have any value without you. And so the qualified small business consideration probably doesn't come into play as much. So I think that's what we have for now. Hope that answered it. I'll turn it back over to you, Dirk.
All right, thank you, Eric. Thanks for the questions, everyone. And moving on to saving for retirement. And so first, it's always interesting that we put start planning early, and sometimes I feel like this is a slap in the face if you didn't start planning early. And I think the real message here is, if you're not saving and you plan to retire, you should start saving now. And so obviously the benefits of compound interest and compounding those returns over years helps the earlier you start. But there's two times to start saving, and one was when you're in college or earlier, and the other is now if you haven't. So I think that's the message here. Start saving as early as you can. Save, as you've probably heard before, have it automatically deducted from your paycheck if saving is difficult for you, and you probably won't miss it. If you think you're going to miss it, if it's too big of a chunk, do it incrementally. Set a plan to start saving. If it's $1,000 a month, if it's $10,000 a month, whatever that number is, and then grow it incrementally from there, and continue down that path. You can save as much as possible, and there's limitations on how much we can save from year to year in tax-deferred vehicles. This is your qualified plans like a 401k or 403b. It's IRAs. This slide is just here to show what the power of tax-deferred savings can be. So it illustrates contributing $6,000 a year to both an IRA and a taxable account, earn 5% on that, and you grow that over time. You can see the power of not paying taxes each year, and instead allowing those earnings to continue to compound. Turns out to about $20,000 after tax. You still have to pay the tax on the IRA at some point, and so after these 30 years in this illustration, about $20,000 difference in letting those returns compound. So the old adage, "Pay no tax before it's due," really shows here. And then where do you begin? So we get this question a lot. Most high-earning physicians that we work with, you've maxed out your 401k, you've maxed out, or maybe you haven't. You're wondering, where else do I save? I put my $20,000 away in my 401k this year, or $27,000 if you're over 50. You have an IRA. Can you contribute to it? Can you not contribute to it? Should you contribute to a Roth IRA? And then you have taxable investment accounts. But the question is then, how much should I save? And I think that there's calculators online that you can find that show, well, you want to live off of $200,000 a year in retirement. Well, how much do you need at your retirement age, or when you plan to retire? You may back into that number instead of saying, okay, well, I can't save the $50,000 a month that it's suggesting I need to save. Maybe instead I need to say, what can I save? And you back into your budget from there and say, well, I can put aside $5,000 a month towards that goal of saving, and so you go from there. What I'll say is, I think I'll get to it in the next slide or a slide or two. There's a couple of different plans available through your employer, likely if they offer retirement benefits, which most do today. Pension plans, or what's known as defined benefit plans, 401k and 403b plans, or what's known as defined contribution. The name really describes them well. Defined benefit, you may, these are going, they're hard to find today. We don't see many pension plans today, and that's because if you look at who contributes, who makes the investment choices, and really who assumes the investment risk in a pension plan, that's the real issue that we've seen. You've likely heard in the news stories of underfunded pension plans. What that means, because they're defined benefit, these plans say, if you work for us for X amount of years throughout your retirement, you're going to get X percent of your income, your last 3 years average. You're going to get 80% of your last 3 years average income for the rest of your life. And so as actuarial tables or maybe investment assumptions put into these plans that haven't panned out the way they were hoped to pan out. These pension plans often have become grossly underfunded and can't meet their obligations. And so defined benefit plans, the risk lies with the employer, the investment choices lie with the employer, and you're just a participant in the plan that gets the benefit of it. Contrast that with a 401k or a 403b plan, which is a defined contribution plan, meaning you define what you contribute to the plan. And all the risk, all the investment choices, all the onus is on you to contribute to this plan. And so you contribute over time to these plans, and that balance grows. Maybe you're a very risk-averse investor and you put it in bonds, and your $100,000 doesn't grow as much as someone who takes more risk, or maybe you have more money at the end because the risky person had caught a bad run and retired in 2008 and didn't have as much money. So the investment risk, the investment choices in your 401k and 403bs all lie on you. And so the 401k, 403b, these are plans that are set up by your employer. In 2022, you can contribute a maximum of $20,500 if you're under age 50. If you're over age 50, you get to put another 6,500 in, so a total of 27,000. These are in a traditional 401k or 403b. These are tax deferred basis. I should pause here because we have traditional and Roth, and we see these now in both 401ks and IRAs. Think of it in how I tried to explain these traditional and Roth. Think of a house, and the IRA is a house, and the house has a back door and a front door, and the door is the tax collector, and you either have to pay the tax going into the house or you have to pay the tax coming out of the house, but you have to pay the tax. There's no free lunch. And so a 401k, you enter the door, you enter the house without paying taxes. So that 20,500 that you contribute to your 401k, you're not taxed on going into it. Now, we saw that it grows tax-free, or tax deferred, I should say. And when you take money out of your 401k or 403b, you have to pay taxes on ordinary income taxes on what you take out. Contrast that with a Roth. There's no tax deferral in the Roth. To put 20,500, you have to pay taxes on something greater than 20,500 first, and then you put that money in. But then the back door you pass tax free. To get out of that, because you put your money in on the before you enter the front door. You pay the tax in, you don't pay it on the back end. So as we go through this traditional and Roth, you'll understand a little better. Hopefully, there's none that you don't pay taxes. You have to pay taxes either going in or coming out. And so with this one, talking about the traditional for now. And then with traditional also, you are required to take require minimum distributions at a certain age. Right now it's 72, which changed a couple of years ago, but that is what it is now. Key benefits: many 401k, 403b plans have an employer match. This might be something like they'll match you 50 cents on the dollar, dollar for dollar, up to a certain percentage of your salary. If your employer offers a match, we always recommend taking advantage of that, contributing to and getting as much money as you can in the 401k or the 403b, the qualified plan. And taking advantage, get that 3% match. We have a slide here and a couple down that shows the benefit of that employer match. You control obviously how much you contributed and where that investment is, or where that money is invested. To an extent, your employer may limit the investment options that you have to certain mutual funds. Again, pre-tax contributions, tax deferred earnings, that's what we just described, and same with the Roth. You're going to pay the tax either going in or coming out, and so you're going to be taxed one way or another. The loan potential, some 401ks, some 403bs, you can take a loan against your balance there, and that's just you'd have to consult your plan to see if that's something that's allowed in your plan. Credit protection, this is qualified plans, IRAs as well, have exemptions from creditor claims. This is why we saw O.J. Simpson still living a pretty lavish life after declaring bankruptcy. He still had a lot in IRAs that was exempt from creditor claims. Responsibility is yours. We talked about that. Vesting. Any employer matching that you have may have a vesting requirement on it, which means you may have to spend 4 years at your employer before that matched money becomes yours. Again, it's plan specific, and you'd have to check your plan to see what those vesting requirements are. And then penalties, if with any qualified plan or any IRA, if you're under 59 and a half, the chances are there's going to be a penalty if you withdraw this money early, and there's exceptions to that. We'll talk about some of those. So this just shows an illustration, over 20 years. With this example, the employer matches $3,000 a year on a $100,000 income. So in 20 years, the employer has matched $60,000. It's grown to about a $100,000 difference. So if you didn't have that employer contribution and just saved your on the left-hand side $3,000 a year, or maxed out your 401k at $20,500 on the right-hand side, you can see either scenario, the employer's $60,000 over those 20 years grows to about $100,000 in extra income, if you will. Going back to that free money, it's that match is an additional benefit to you, and so it can be very valuable over time. Non-qualified deferred comp plans, the thing I'd caution here, if you're ever offered a non-qualified deferred comp plan, make sure of the solvency, long-term viability of your employer. And I say this because I've had a client that had a deferred comp plan, and the employer, 15 years into his plan, went belly up. And so you see over other considerations, the deferred amounts are subject to their claims on the employer's creditors. So what deferred comp is, you agree to a deferred compensation plan, which means rather some portion of your earnings this year gets put into this plan and is not taxable until sometime at a future date. So maybe you contribute $20,000 a year for the time you're employed, and at age 65, this starts kicking off to you another $20,000 or $40,000 a year, whatever the number might be, for the rest of your life. And so that is we see these occasionally, but no, like I said, that's always the one thing that I really, and I guess it's just experience of having been part of one of those where a client lost considerable amount. It's always it kind of makes me nervous to see these, but and then retirement plans for the self-employed. There's now, which this slide doesn't cover, individual 401ks, which are fairly easy to set up. Maybe not as easy as a SEP or a simple. A SEP is a simplified employee pension plan. A simple is a savings incentive match plan for employees, is the acronym there. And so it's really just, there's a couple of considerations that would go into where should I set up a SEP, where should I set up a simple, where should I set up an individual 401k, and that's probably best talk to your CPA about that. We'll go into a little bit detail on each. The simplified employee pension plan, SEP IRA, is what you might often hear. You can, it's a percentage of your income that you can contribute up to $61,000 a year. It's discretionary, so you don't have to do it in every year. If maybe you didn't have, going back to the individual that asked the locums question, maybe you didn't, you did more consulting in one year than another, or worked part-time, or filled in more for one than another. But the plan must be filed, or must be established by your tax filing date, including any extension. So what this means is, April comes around and you didn't set up a plan for 2021, but this is 2022. So April of 2023 comes around and you say, oh, I want to set up a SEP. You could actually set one up for 2022, even though it's after the year end. SEPs have higher contribution limits. That's one of the benefits. You can put away a lot of money, $61,000 in any given year versus the $6,000 in a traditional IRA. There's no ongoing IRS filing requirements. And so it's pretty simple plan. As I said, again, penalties will apply to early withdrawals, most likely if you're under 59 and a half. And it's your risk. You're assuming all the responsibility for your SEP plan. Same with simple. Simple is for, if you have a small, if you're a small employer, you have, I think the limit is 100 employees. Under 100 employees, you can set up a simple IRA. And again, you can contribute up to $14,000 annually. There's also a $3,000 catch-up provision if you're over 50 years old, so 17,000 total. Again, it's very similar. It's simple IRAs, SEP IRAs. It's a form. It's an ERISA plan that falls under the IRAs, and so they're pretty simple, pretty straightforward. The one limitation does not provide the maximum benefit, reading from the right, if you do not have employees who need to be covered by the plan. So if you didn't have employees, you might opt for the SEP instead, just because it's you can contribute more. And then we get to the IRAs, and the IRAs we'd say is secondary to all of these other plans. So you can contribute more in a tax deferred or tax advantaged way to a 401k, 403b. So max those out first, and then what I'd say is as high income earners, and I'll make a general statement, thinking as a physician, a high interest or high income earner, you probably or maxing out your 401k or 403b. I hope that you are, and then you're coming and saying, what should I do next? Where else should I save money? And then I would tell you to open up an IRA. I probably advise you to open up a Roth IRA. And you say, well, I make too much money to open up a Roth IRA. And I say, well, we'll open up a traditional IRA, and we'll do what's called a backdoor Roth IRA, which means, you're making enough money where your contributions to an IRA are non-deductible contributions anyway. And so, since you've already paid tax on that money that you're putting in an IRA, you can convert that IRA to a Roth IRA each year. You put your $6,000 in, you convert it, on a non-deductible basis, so you don't get a tax break for doing that, and then you convert it to a Roth IRA. Why a Roth IRA? Because a Roth IRA has no required minimum distribution when you turn 72. And so as good stewards of your money and good savers, over time, you'll save money in your qualified plan, your 401k, your 403b. And what I talk to clients about is your Roth IRA. Think about it as a legacy asset for your kids, in which case you'll never pay another dollar of taxes throughout your lifetime in your Roth IRA. And then you pass that on to your kids, and your kids will never pay another dollar of taxes. It grows another 10 years after your death before your children are required to distribute it and take the distribution out, tax-free, fully tax-free. So you think of your entire lifetime, those compound benefits that I mentioned earlier of tax deferral or tax-free growth, and then you pass that on to your kids, and they let it grow another 10 years without having to take a distribution. And then when they finally do take a distribution, all of that growth is tax-free. So that's why I typically guide our clients more to, after they're maxing out their 401k, after they're maxing out their 403b, let's do a non-deductible traditional IRA. We'll convert that to a Roth every year and build a legacy asset for your kids, on top of saving elsewhere. We'll show that as well. The benefits of a Roth, I think we've covered a lot of these. You can make after-tax contributions and tax-free withdrawals, and I think that's the biggest benefit. Tax-free withdrawals. There should be an asterisk here. I think there should be an asterisk here that says tax-free withdrawals today. And if you remember, Social Security was never supposed to be taxed either. So at some point this may change. Will it always be tax-free? I hope, I think, but maybe we need to quantify that a little bit. So distribution rules differ. There are reasons if your Roth IRA has been in place for 5 years, you may be able to take the money out without a penalty if you're under 59 and a half. And you'd also, but you would pay taxes on the earnings most likely. And then the same thing with traditional benefits. You can get a tax deduction today. Potentially, you can let this money grow tax deferred, and then you pay the taxes on the back end. Potentially, when you're in a lower tax bracket as well. Am I missing anything? The required minimum distributions on the traditional start at age 72 today. And so what does that mean? At age 72, you have $1 million in your IRA or your 401k that you now rolled over to a IRA rollover account. And at age 72, you have to start taking a percentage out of your 401k or your IRA, sorry. And again, this goes back to the analogy of the house and the two doors. All this required minimum distribution. This is the IRS saying, look, we're going to give you this benefit, but it's again, there's no free lunch. At some point, we want to collect taxes on this income you earned, and so we're going to force you to start taking it out. And the way the actuarial tables work, the expectation is at you will die with $0 left in your IRA, and we know that doesn't happen. And so there's distribution rules for your heirs as well. But that's how this is expected to work, is that, maybe at 72, it's 3% of the account value, and that percentage grows each year until at some point you theoretically distributed, all of your IRA. And then if you don't, your heirs, your spouse, your kids will inherit it, and they have 10 years to distribute it. But at some point, again, the tax man gets his cut of what you've made. And this just shows all of what we just talked about side by side. Again, making sure I didn't miss anything. The same $6,000, $7,000 if you're over 50 contribution. Income limits apply to Roth IRAs. Again, maybe another place for an asterisk here. Yes, but today we can do these backdoor Roths. That may change. They tried to change that last year in Congress, and that got tabled for now. Contributions tax deductible, maybe in the case if you have an employer plan, chances are not deductible. I should stress, again, as high income earners, you may have a spouse that isn't working. In both of these plans, you can contribute. You can contribute a spousal IRA. You can contribute on behalf of your spouse if you both or if you're married and you want to put something away for your spouse, assuming there's enough earned income. You can contribute on your income for your spouse who may not have income. Again, this talks about the limits, the deduction limits. Again, I'm assuming that many of you are most likely making non-deductible contributions to your IRAs, whether that be because you're covered by an employer plan or or you may just make enough money. And then this gets into some of the reasons or some of the exceptions why distributions from qualified plans or IRAs may not be subject to the 10%. So the most common hardship is the most common we see. You have something going on in your life that requires a hardship distribution, but all of these reasons apply, and of course the always disclaimer: you should speak to your tax advisors. We had we've had 5 slides here talking about tax advice, but we don't give tax advice. Is the usual disclaimer. So always talk with your tax advisor. And so with so many choices, where do I begin? We kind of covered this throughout, and I'd say, first of all, go back to part 1 of our webinar series and save that emergency fund before you start contributing to a 401k or 403b. Save for that emergency fund. Pay off your any high interest credit card debt or anything of the sort. Something that your earnings within these plans are not going to overcome the interest rate that you're paying on bad debt. That's not to say pay off all debt. I believe that there is good debt. But credit card debt is not good debt. So pay that off first, and then once you have that savings, that emergency fund, then I would say max out your 401k, your 403b, whatever that might be. Max it out every year. Don't stop. Don't pass go. Don't collect $200. Max out your 403b, your 401k. And then do a backdoor Roth on top of that, $6,000, $7,000 if you're over 50. Do one for your spouse as well if they're not working, or if they are working, do one for them anyway. And then taxable investment accounts. That's whatever left over. You want a rainy day fund. And we try to advise clients on several different taxable investment accounts is one place you again diversify your holdings. You might have investment real estate as part of this taxable investment accounts. It's a blanket statement. This is where everything else goes that you can't save on a tax deferred or tax-free basis. The other thing that's not listed here, which we see a lot in high income earners, and we certainly can help with this. If you're insurable, we do occasionally do what we call a super Roth, if you will. And this is using an insurance product, an overfunded insurance product, to really build a cash value inside of a life insurance plan. So you get life insurance, but you never expect to use this insurance policy as an insurance or for the life insurance purposes. Instead, you intend to use it as kind of a Roth IRA on steroids. So you're putting this money into into the insurance plan on the front end. It grows tax free, essentially tax free withdrawals. You let it grow for several years, and at retirement you have a source of tax free income from this insurance policy. Whether that it's considered tax free either because of its return of premium, and then once all of your premium is returned, it's a policy loan that is paid off with the death benefit of the policy at death. So that's another thing we see with physician clients, high income earners. You've maxed out your 401k, your 403b, you maxed out your IRA, and now what? You've done some investment real estate. You have an investment account that your trust that's held by your trust, and then here's another source of retirement income. We put this insurance policy in place, and so that wraps it up. We'll go over, make sure there's no other questions. For the attorney, oh, that must be for Eric. Locums is a doctor that works temp jobs. We get jobs through companies that are contracted by medical institutions.
I can take that. Yeah, so
Yeah.
that's just a follow up. That's just a follow up from the clarifying the term. I didn't know what it means, so I learned something new. So locums is basically a temporary doctor that gets jobs through a temp agency. So first and foremost, I would say that the choice is not LLC, S corporation, C corporation versus independent contractor. Independent contractor is just a general term in terms of someone who gets paid via 1099 versus a W-2 employee. So even if you set up an entity and then had the entity be the one that receives the jobs from the temp agency, that entity is still going to be classified as an independent contractor as to the hospital or the institution that's paying it. So that doesn't change it. It will still be the 1099 will just be issued to the entity, and the entity will now be the independent contractor. So the choice will there be between the type of entity that you would like to choose for doing business, that temporary physician work. I suspect, without having ever looked at it, that's still considered a medical practice, even though it's a solo person who operates only as an independent contractor. So therefore, the LLC limited partnership likely aren't going to be available because the only avenue for a medical practice is the professional corporation, because part of the rules for professional corporations require the licensing and approval of the California Medical Board. And so I suspect that if you choose to set up that business, that temporary physician business as an entity, you're going to be limited to a corporation. It has to be a professional corporation. Then your choice will be whether or not you want to be taxed as an X corporation or a C corporation. I suspect that if this is just a solo operation, there's probably not ever the potential that this business will be sold at some point down the road. It's basically just a wrapper that protects you from some limited amount of liability while you practice. So if there's never going to be a tax-free sale and you're never going to have to get qualified small business status, then you probably, a C corporation probably doesn't make sense with this type of business, and you're probably going to be a professional corporation taxed as an S corporation. So, but that being said, this might be a situation where you're not really getting that much from being an entity anyways, because remember, an entity is to protect you from liability of the business. There really is no business liability in this type of business that I would see other than the malpractice of the physician, the potential malpractice of the physician. And a physician is still liable for their own actions, even if they operate inside an entity. It doesn't insulate you from liability, the liability resulting from your own actions when operating inside the entity. An entity insulates you from the actions of others. So other shareholders, other physicians, it insulates you from the actions of the business itself. So, general business liability, slips and falls on the premises, things of that sort. So in a temporary physician situation like this, I don't know that there's a whole lot of liability to protect from, because the entity won't protect you from potential malpractice, and that's probably the only real potential liability out there. But in any event, it might still be better. There might be other things that I'm not aware of in terms of that you might be exposed to that would be potential liability, in which case the professional corporation taxed as an S corporation is probably the way to go. I would just check and make sure that the institution doesn't have any internal rules that would prohibit them from paying an entity as opposed to an individual. Make sure that that's not going to create any hurdles to overcome in terms of accepting new assignments and the temp agency paying the entity as a 1099 independent contractor rather than you, the physician, as the 1099 independent contractor. So I hope that helps, and thank you for educating me tonight on what a locum is.
Thank you, Eric. Next question, is it true it's better to pay taxes up front so that whatever gains you get on your retirement fund as the years go by won't be taxed? Potentially, I guess we could run we could figure that out pretty easily, definitively, but it probably depends on your tax rate as well. And so personally, I love Roth IRAs. I don't mind paying the tax today to allow that to grow, whether that be in a Roth 401k or a Roth IRA. And also because I like the flexibility of not paying the taxes, the tax-free on the back end. So I think it's, you can probably, you'd have to make some assumptions to get there, but what's your tax rate today versus what your tax rate is going to be in retirement. We can again make assumptions. We don't know what that tax rate might be, but we can make assumptions. It's the common thinking is that your tax rate is going to be lower or potentially lower in retirement because you're not earning as much money. And so it can be shown that deferring those taxes could be better. But again, it's probably individual, case by case. I don't know if it's better one way or another. Final question that I see, you say to save as much as you can in different accounts, but how much does one really need? Great question. Here's what I guide to. If let's say you want to live off of $100,000 a year in retirement, or $200,000 a year in retirement, so you back into what number do you need? What's your number? This is often a question you hear asked. What I guide to, so there's been countless numbers of academic studies on what is a sustainable withdrawal rate from an investment account, and no matter the time period studied, no matter the investment allocation, a sustainable withdrawal rate has historically been shown. However many studies I've read, it's always somewhere between 3 and 6%. And so a conservative person might err towards the lower end of that and use 3%, 4%. What does that mean? If you save $1 million by the time you're ready to retire, you can expect to take about $40,000 a year from that account, and it should last in perpetuity. It should last throughout your lifetime. So a 4% distribution rate, $40,000. You have most likely Social Security to add to that. So maybe $20,000, $30,000, $40,000 on top of that. Social Security. So you get to that number. You talk about I want to live off of 100,000. Well, you might estimate you get 25,000 of that from Social Security, and you need to plug that 75,000 each year. So where does that come from? Well, maybe you need to save about $2 million based on a 4% withdrawal rate to get that other $75,000. So it's really what it comes back to you. How much do you want to spend in retirement? And what I'd say, I think throughout my career the thinking has a little bit changed. It's people used to say, oh, well, you're going to spend less in retirement, and I don't know if that's particularly true. It's not been what I've seen in my 22 years of being in this business, and I've had long-term clients that have gone through retirement. I know what they made before they retired and see what they spend through retirement. And what I'd say is your spending just changes a lot. It doesn't necessarily decrease as you age, because you might early in your retirement spend more on vacationing and more on travel, and as you age, you spend less on travel and more on healthcare, more on making sure you're healthy. So that's kind of how I'd say figure out what you need. Maybe that's a percentage of what you earn today, smaller than what you make today. But I wouldn't necessarily plan on it decreasing throughout your retirement. And then as life expectancies get longer, I think you have to think about a longer retirement, and maybe as we age healthier, I think we can continue to do more longer in retirement. So maybe that number isn't as reduced as you may think from what you're making today. So that's how I'd answer that. Hope that answers those questions. And we'll move on. So we structure, I think about help when we help our clients, I think about it in the form of lifestyle, legacy, and philanthropy. And so when I think about that, lifestyle is helping you with your what you're doing today. And again, a lot of our clients, high income earners as yourselves, you've probably are on your way to checking that box off, the lifestyle box. You're providing fine for your lifestyle. You're starting to think about legacy, and then to varying extents, people think about philanthropy and how do we give back? What is philanthropy? Well, it's the giving back, the love of humankind, and the active effort to promote human welfare, the donation of human or financial capital to charity. So just giving back ourselves, whether that's writing a check, whether that's donating goods, services, our time. And if you've ever given, you know the benefits of giving already. You get the personal fulfillment. It's an opportunity to make an impact. It's an opportunity to establish a legacy, and maybe a bit nefarious. It's income and estate tax savings. And there's ways to give. You can give your time. You can give your write a check. You can donate your securities. I think that it's highly preferable if I was your tax advisor. If you're going to give $100,000 and you have maybe some appreciated securities, you might find a way to donate those securities instead of the cash. And therefore save on the capital gains. If you had to sell the stocks first and realize capital gains and then donate the cash, then you'd have to owe some taxes on that. Donor advised funds, private foundations, alternatives. Eric might have some comments later when he talks about more of the tax benefits. But with the higher standard deduction that we're seeing today, grouping years of investments into 1 year may be a way to capitalize on that, on getting past that standard deduction and actually getting some credit for what you're giving financially. And then the last one, volunteer, giving of yourself, giving of your time, your talent. We're seeing more of this as physicians. You have a way of doing this where we're seeing more and more of traveling to remote countries, emerging world countries to give of your services, of your talents as physicians. I'll go through these pretty quick just because the next 2 pages are basic rules, and it's really just keeping a good record of what you're doing, what you're doing, who you're giving it to, keeping records of it so that at tax time, if you're trying to capitalize on that, you have all the records of what you did. The same thing. You have 2 pages of telling you to keep good records. So it's pretty important if you're looking to like I said, for tax purposes, your CPA is going to want to see that at the end of the year. If you ever get audited, you're going to need the records to show why you deducted these things. Eric, you want to take over here?
Sure. Yeah, I think it's a logical point. So really, the general rules that we were talking about largely, apply when you're talking about considering donating to a public charity, one that's already in existence, one that you want to support, either volunteering your time or making some sort of cash contribution. or making a contribution of appreciated securities. Then we move on to what I would call more advanced charitable planning. These are typically clients who are more tax motivated, so they want to set up the most efficient tax structure, but also very philanthropic. So if you're looking at larger cash gifts, or gifts of appreciated securities, or even gifts in closely held companies or real estate, things of that sort, you're typically looking at setting up either a donor advised fund or a private foundation. And these are really designed for larger gifts. They are slightly different in their structure, and then a donor advised fund is really just a fund intended to hold assets, usually cash or marketable securities. And then ultimately you get a charitable contribution in the year that you contribute to the donor advised fund. You set up the donor advised fund for yourself. It's really just a separate account, typically at the financial institution that you already have a relationship. And ultimately down the road, you get to decide who the donor advised fund is going to make charitable grants to. And so it combines kind of the upfront benefit of giving, the charitable deduction aspect of it, but ultimately you don't have to decide who the charitable grant should go to until at some point down the road. There's no requirement. So, and once the assets are in these donor advised funds, they grow tax-free. It's a great option in lieu of a public direct giving to a public charity. A lot of our clients use it in a year where they want to make a large contribution, but they don't necessarily want to distribute all that amount out to charities in the first year, or they don't yet know exactly which charities they want to support, but they know they want to get a large charitable contribution this year, so they'll use a DAF. Private foundation, similar to a DAF, but it's actually a legal entity. It's a corporation typically, same organization documents that I talked about earlier when setting up a business, filed with the Secretary of State. But then it's more like an operating business. And so you typically, same thing, it will receive funds, upfront charitable contribution, but then that private foundation operates like a business to find charitable causes that it wants to support. It's actually required to make distributions each year. And then I think it has to distribute 5% of its assets to charitable entities, to public charities each year, subject to certain penalties. So really, this is for clients who want to be more involved. They want to be involved in the operation of a charitable business. They'll choose a private foundation. If they just strictly want to put a lot of assets into charity, get the deduction, make a decision later about who should receive the grants, then a donor advised fund makes a lot more sense. And the tax rules associated with the donor advised fund are more beneficial. There's a higher limitation in terms of how much of the donation to a DAF can be deducted. Typically 50% of adjusted gross income, you can receive a charitable deduction. Private foundation, limited to 30% or sometimes 20%, depending on the type of assets you're giving. Typically you just get a better tax deduction. So that being the case, and it's simpler, most people choose a donor advised fund at least first. If for some reason that's not allowing them to fully carry out their charitable intentions, they want to be more involved in actually operating a charitable entity, then they might graduate to a private foundation. Charitable lead trust, charitable remainder trust, even more advanced strategies. These typically combine some sort of liquidity event, sale of a business, for example, where they're going to have a large upfront tax bill in a given year. So they want to fund some big strategy that's going to produce a charitable donation. So you might pursue a charitable lead trust, which is essentially a trust that says it will pay out an annuity amount to charity year after year. Usually has a term, 10, 20 years, something like that, life expectancy, you pick a term. You can upfront, you can load the charitable deduction upfront and get the full benefit from that in year one, but then do the charitable giving over a period of years. And that produces a large upfront charitable deduction. So think of it as kind of preloading the next 20 years of charitable giving into a trust upfront that gives you a large upfront deduction in a year where your taxable income is going to be abnormally high. Charitable remainder trust, not as big of an upfront charitable deduction. Basically, it's a trust that you contribute to. An annuity amount will come back to the grantor, so come back to you if you set up the charitable trust for a period of years, or can be set for life expectancy. And then at the end, whatever remains in the trust goes to charity. so you get a charitable deduction, but it's only based on the present value of that remainder interest going to charity, so it's typically smaller. However, the advantage is you can contribute an appreciated asset to a charitable remainder trust, like an interest in a business prior to the business being sold. And so then when the charitable remainder trust receives that asset, turns around and sells it, because the charitable remainder trust is a tax-exempt entity, no capital gains is incurred at the time of sale, like it would be if you, the individual, sold the asset and then contributed the cash to the charitable remainder trust. So there's a capital gains tax deferral element of a charitable remainder trust and a small charitable deduction. Again, people are pursuing these typically in years when they have big philanthropic giving they know they want to do over a period of time, but they could use a big deduction in this year. And so, so these strategies are often employed after, I would say, direct giving to a donor advised fund. I think that's it.
Any more questions? We got one more question, looks like for you, Eric.
Is an S Corp better tax-wise than a sole proprietor? Yeah, I see that. So not substantially different. There's going to be miscellaneous taxes. There's going to be filing fees whenever you have a corporation. But at the end of the day, an S corporation is a pass-through entity. So all the income will pass through to you and be taxable on your individual income tax return. That's the same as if you didn't have an entity. So there's some miscellaneous filing taxes and some different taxes that do apply. So you'll have some miscellaneous taxes and fees for the privilege of doing business as a corporation. So that will make it slightly more expensive than a sole proprietorship, but not dramatically different. And you'll get the liability protection for the business's liabilities when you set up an S corporation, as opposed to doing business as a sole proprietorship. So that's the trade-off.
All right. Well, thank you, everyone, for joining us. If you had a question but didn't ask it, or if you have follow-up questions, our contact information is there on the screen. Jen has also said you can get the slides directly from her. If you want to follow up, you're more than welcome to follow up with us to get the slides. But any final remarks, Jen?
No, I want to thank everybody for joining us this evening. And again, thank Eric and Dirk for another terrific presentation. Anybody that does want a copy of the slides, please feel free to send an email to sdcms@sdcms.org. Also, if anybody has suggestions for future webinar topics, we'd love to receive those. So please feel free to email those to us as well. And lastly, if you're a physician and not yet a member of the Medical Society, please consider visiting our website at sdcms.org, where you can find more information about membership and can quickly and easily join online. Thanks, everybody. Have a great evening. Good night.